Today, we're going to be going over the JP Morgan watch list, Apple's new releases and dividends, the current state of the economy, the situation with China, the coronavirus, and the right to repair bill that was introduced in Congress. Hello everyone and welcome to Stock Talk. We're going to analyze the previously mentioned issues and the possible impacts that they could have on Apple shares. Then we'll decide whether it's a good idea to hold or sell your shares. And remember to smash that like button and subscribe if you haven't already. Let's get down to business. So, first things first, JP Morgan analyst Samik Chatterjee recently added Apple to JP Morgan's watch list, and I think that's something worth noting. He believes that the current price of Apple stock could jump from $149 to $175. That's a 17% difference. If you're currently holding 100 Apple shares, that's a profit of $2,600. That's enough to cover rent for a whole month in Manhattan. You can thank me later. What caught my attention is that Apple has managed to increase its service revenue by adding services such as Apple Arcade, Apple TV, Apple News, and Apple Card, which will likely grow in the coming months. Apple also made a foray into the gaming market. The App Store has always allowed people to purchase games, but Apple is now allowing users to have an all-you-can-eat buffet of games for a flat fee each month. This was likely their way of competing with Google's video game service, Stadia. Google publicly announced in February that they were shutting down Stadia and that they would stop developing games for the platform. Now you might be thinking, this is a video about Apple, why should I care about what Google does? The reason you should care is because with Google out of the equation, Apple now has the opportunity to seize a larger share of the market, which means higher share prices. Not to mention, holding means that you may be able to ride the current 5G phone boom. Based off Apple's recent dividend history, we can likely assume that future dividends will hover around 20 cents for the next quarter. The longer you hold, the more dividends you get. Selling now would mean missing out on future payments. How else are you going to afford that rent in New York? Economists have also been saying that the economy is seeing a resurgence, and just about everyone is getting more eager to start going out so they can spend their cash on $18 cocktails. Additionally, with Apple's ever-increasing amount of products, people are going to have more options to spend their money. On the flip side, tensions between the United States and China are increasing. Taiwan is a US ally, and China has begun to display aggressive behavior towards the country. In addition, the United States has levied accusations of genocide against China. This is important because China is where Apple manufactures their phones. If tensions were to reach a boiling point, we could be looking at higher tariffs on goods flowing from China, which could reduce Apple's profit margins on their products, thus leading to a lower share price. There's also the possibility of the United States levying sanctions against China, which would force Apple to manufacture its products in locations where labor costs are higher. This, once again, translates to a lower profit margin and a lower share price. With that being said, I think it's highly unlikely that tensions between the US and China will spike quickly enough to wipe out your investment. This will likely be an issue in the long term, not short term. Of course, there is the chance that a new coronavirus variant could take the world by storm and infect vaccinated populations. There are sizable portions of the US population that remain unvaccinated, which could provide the virus a higher chance of mutation. The Delta variant has already spooked investors, even though it is rare for it to infect vaccinated people. You don't have to be a genius to imagine what would happen if a new variant could infect vaccinated populations. So, if you need a good reason to get vaccinated, do it for the economy. Your wallet will thank you. Also, wash your hands. But it's worth noting that the coronavirus, or any pandemic for that matter, is going to affect different shares differently depending on the nature of those businesses. Live Nation, for example, suffered a rather steep drop as the United States went on lockdown back in March of 2020. This is because Live Nation generates much of its revenue from selling tickets for in-person events. Any virus that thrives off having a bunch of people crammed together in an enclosed space is going to devastate such a company. I mean, you can't exactly get the same experience from an online concert. Nothing beats standing in a crowd while your hearing gets damaged for an hour straight. I don't believe lockdowns are going to affect a company like Apple as much. You can order an Apple product online or buy it in person. This means that even if Apple did have to close down its retail stores, they would not lose as much revenue. Apple's streaming services can also be enjoyed in the comfort of your own home, and many of Apple's employees are able to work from home due to the nature of their work. Let's hope their employees don't procrastinate on their work by watching Apple TV. As a matter of fact, more people staying at home in their pajamas could mean more revenue for any business that derives a significant portion of its revenue from streaming. Many movies were released online due to the fact that movie theaters couldn't conduct business, and it seems that the pandemic may very well have accelerated the decline of movie theaters, since studios have had the opportunity to see the effectiveness of online releases. Another thing to pay attention to is the right to repair bill that was recently introduced in Congress. As the name entails, the bill would require companies to make it easier to repair the products they sell. This would mean that consumers could hold off on buying a new smartphone or tech device for much longer than they normally do. This in turn could lead to them purchasing fewer tech devices, leading to lower profits for Apple. The fact of the matter is that it takes a while for a bill to become law. It would take up to a year for the bill to pass. Of course, a bill can quickly pass if Congress prioritizes it and has a compelling interest in getting it passed quickly. But that doesn't seem to be the case here. Congress is often juggling multiple bills at once, and if the right to repair law was of high priority like the other critical pieces of legislation, we would see some rather heated debates going on. Now that I think about it, Congress doesn't really get anything done quickly, mainly because they don't get anything done. There does not seem to be any reason to believe that the right to repair law will cause Apple shares to drop anytime soon. Any impacts that it does have will likely not take effect until after a year, which is plenty of time to collect dividends from the shares you're holding, or to cash in later. Ultimately, I think the best decision to make here is to hold on to your Apple shares. Even as the economy tanked in 2020, it was not as badly affected. It's a resilient stock, and if it can weather a pandemic, it can probably weather whatever 2021 throws its way. Please leave a like if you found the video helpful, and leave a comment telling whether you think it's best for Apple shareholders to hold or sell. And I'll see you guys in the next video.